Let's focus on US GDP data. Now, US GDP has gone up at a 2.1% annualized rate last quarter. It has been revised down from that 2.4% pace that was reported last month. US economic growth revised lower to a still solid pace in the second quarter, but the momentum appears to have picked up early, and this in the third quarter because we are seeing a tight labor market which is underpinning consumer spending. So the US economy has grown at a 2% pace in the first quarter, and it seems that it's going to continue to push ahead despite 525 basis points worth of interest rate hikes from the Federal Reserve since March 2022. Let's find out where the US markets are headed on the back of this kind of data. And for that, Jose Torres is with us, senior economist for Interactive Brokers. Great to have you back on the show with us, Jose. You have been digesting US GDP numbers. Now, what does that tell you? Because as far as the markets are concerned, it gives further clarity to them to a certain extent that the Fed will perhaps give growth that much more of a chance over the price rise and will go easy on interest rate hikes. What does it tell you?
Thanks for having me, Vikram. Well, I think that the most important piece of data from this revision was that the core PCE numbers also got revised lower. And what we saw from yesterday with the lower than expected JOLTS number, this market wants any data point that points to less Fed will be celebrated by this market, and that's what we're seeing. We also had ADP private payrolls this morning come in below expectations, and I think as we move into the later parts of the third quarter and the fourth quarter, I think that the focus is going to be less on bringing inflation down because inflation is coming down. I think the focus is going to be more on what are the costs of bringing down inflation. Of course, less job opportunities, slower consumer spending, and less momentum for servicers on the revenue side.
So what are the expectations on American inflation now, Jose, and how is that going to have a telling effect on what the Fed does in September?
Well, right now we think that September is going to be a pause just because these numbers were getting support more of a wait and see approach, but we do think that November is going to be the final hike, and we don't think we're going to see cuts till the second half of next year. We think that goods prices are coming down, commodities are a wild card. One month they go up, the next month they go down, and services have remained pretty hot, and that's a labor intensive area. So we think that if the Fed talks about pausing too early or even hints at cutting, we think that inflation will accelerate once again pretty quickly and go back up to 4%. We think though in the long term, next 5 to 10 years, we're going to be in a new era of 3 to 3.5% inflation.